Today is December 13th, 2017. As always, here's your fun disclaimer. This is being recorded. You can always view it at your leisure once I post the replay. So how's everyone doing today? Market's acting up a little bit peculiar. After the post-Fed news here, we can actually look at it. We had some big candlesticks down, and look at that. Downward movement in the Dow, downward movement in the Nasdaq, downward movement at the close on the S&P 500 as it moves down. Now, the Fed came out today and they raised rates again, and they did talk about raising rates 3 more times next year as they're getting closer to their inflationary target. But I'm gonna let you know now their inflationary target has been met and exceeded. But again, if the Fed excludes food and energy, and if you exclude the 2 most important things people use in their day-to-day life to commute to work, to have a job, to sustain their body, well, of course, you're going to have inflation not quite hitting your market there. So take that into account. Now, today we're going to talk about the inflated asset class of the world. And so I have a couple charts I'm going to show you, and they're pretty interesting for data. I did not cherry pick these charts. I just looked at housing, cars, retail sales of used cars, the velocity of money, corn. I actually have a corn future up there, and I have the Bitcoin future. So let's go through that, and you'll find some of these pretty interesting today when it comes to the market. So first up, let's go look at a real medium household income in the United States. It's actually up. Year over year, it keeps moving up here. We're up over $1,000 where we were last year, as you can see right. Last year we were around 58, now we're at 59, so that's pretty good. It looks like Americans are getting a raise, pretty much on track, though rate of inflation is 3%, and wages are at 59,000, they were at 58,000 last year. And so let's go do a little simple addition. Sorry. Oh, we don't even have to do simple addition. 3% of 500 is going to be, I believe, 15. No, that's 3%. That's, I guess we'll have to do a little bit of addition here. Off the head math doesn't usually work. So 0.03, let's go divided. So 59039 divided by 0.03. Oops, did that a little bit wrong. 59039 times 0.03 gives us about 1,777. So last year they made about 58,000. So let's go subtract that. So 59,039 subtract 1,771 subtract 1,771 gives us about $57,000. So it is looking like they're barely meeting to the point of inflation, so that means those raises that most Americans are getting aren't really a cost of living wage. They are just barely below water, just ever so slightly on the real medium household income. Now, this is about the median price between what most Americans make. If you were to look at this number, this is your middle income families. This is your middle class here. They're not quite the low end, but they're not quite the high end, and this is the median price of what most Americans make. And so you can see, no, I'm not really getting about beating inflation here, which is 3% and yearly on a wage increase. So that tells us that the wages are going up, but it's not beating inflation in the market. Now let's go look at something interesting. Now here is the real medium household income of this income in the United States. I looked at that twice. Household income, where is it at here? Oh, looks like I got it. Real medium house price. Sorry about that. Here we go. And we're going to go to Fred again. This is household income. Sorry about that. I have to clear my throat, otherwise I'm going to sound like a frog. So, look at that. Housing is up in the third quarter to $315,000. That's how much that new homes are currently selling for inside the United States. Now, this is sold. This is not on the market. This is sold. And you can see that we have greatly eclipsed the 257,000 high from 2007. We did that about 2013, and then we went from 268, so the high was 2575, so let's go do a little math here. So 257,400 divided by the current price right now, which would be about 35200. So you can see that there has been a 19% increase above the high of 2007. So houses are about 19% higher than they were, while wages really haven't gone up to kind of equate into that. So take that into account. Now, it would show real rent prices as well, but that chart's kind of hard to find, and I didn't update it, but rent is up as well. I could show you the data tomorrow at the meetup. For those who are like, hey, we want that actual data, I can show that to you tomorrow at the normal portfolio growth meetup if you're interested in. But rent's up as well across the United States. So you can see that the middle class did get a raise this year, but the raise wasn't enough to beat inflation, and so you can see that asset classes are definitely a little bit overinflated when it comes to housing. Now, you might be saying, well, Jake, that's just one asset class. That's just housing. Okay. Let's go look at retail sales of autos. So these are the used car numbers. You can see that, again, they're up pretty high as well. You can see that's pretty inflated as well. Now, it is come down. That is cyclical. Now, it usually comes down going into January, and you can see it picks up again. Usually around December is when it picks up. Picks up in the January there. So we are in a typical. So you can see that the prices have gone up as well. Used car sales are higher. Now, you might be saying, well, Jake, what used car sales are up, that's not big of a deal. Well, it is. That means Americans can no longer afford to buy new. They're buying used. Now, in my opinion, it is smarter to buy a used car because a lot of the new car appreciates the second you move it off there. But that means there's not the income to support a new vehicle when you see charts like this. So you can see that car prices are, in fact, pretty inflated from this number. You can see pretty big increase in used car prices since the collapse in 2007. Now remember, the economy was pretty hot in 2007. We had a little bit of a collapse, and then look at that. We had quantitative easing. Now you might be saying, well, Jake, that correlates a little bit. Okay, well, let's go a little bit deeper. In around 2008, we had quantitative easing. We had the Fed buying bonds and making dollars into the market. So you might be saying, well, what does that really have to do with anything? Well, let's go look at the velocity of money. Now, the velocity of money is the amount that the dollar will get you. So I have $1. I go to the store, buy one product. That store uses that $1, buys more product, or maybe buys double the product, and then more people come and buy that store. They have more product to sell. That dollar moves in velocity. Velocity is the rate of acceleration. Or it's not delta, it's the rate of acceleration. And so you can see that really since they've started printing out dollars in 2008 time, the velocity has come way down. Yet prices have come way up. So that means that there's a lot of stagnation inside of the dollar. That means that we're not seeing really money move in the market. Money's stagnating. That means our economy is slowing because people are spending less. The money that's been printed out is just sitting there. It's not really doing anything. People aren't using it to spend. Banks aren't using it to make loans. Even though we saw that the real medium household income price is way higher. So the velocity of money is way down. So you might be saying, okay, well that means my dollar is buying less and less every year. What does that mean? What also means that the rate in which you can get a return on your investment is also starting to thin too. Now, let's go bring this full cycle and let's go look at the S&P 500 from 2008 to now. So let's go look at it. That means that you're going to have to compound your returns every year to get that velocity faster and faster, to get a rate of return in which you're accustomed to. So let's go look at the S&P 500. So this is the S&P 500 right here. Oh, sorry, the SPY. And so using the velocity of money, and so we're looking at a time frame from 2008 to present. Now, 2010, it did spike up a little bit, so we should be seeing a slight correction in 2010. That means the velocity of money kind of moved a little bit more before it tailed off here. So let's go look at a weekly candle chart from 3 years back, and let's go all the way back to 2008 here. So here's our 2008 market, and this is when quantitative easing started coming in around 2008. And then let's look at it now. Now we did talk about, we saw that the velocity of money slightly rounded in 2010. So we should be seeing a nice reversal here in the market when it comes to that. And sure enough, in 2010, right around that time, right around April, we saw that the velocity starting to shift here in the market. So let's go look at the velocity of money again around, if we can, around the 4th month in 2010. So right around, so here's 2010, quarter 1, quarter 2. So around quarter 2 is when we should see it. So look at that, quarter 3. So look at that, right around there is when we saw it. So interesting to see that when the velocity of money starts to kind of slow, you can see the S&P kind of moves up here. That is because, now there's outliers, don't get me wrong, there are outliers, because we can look at 2011, we can see a little bit of movement in 2011 too. But that means that to get these returns, it's becoming harder and harder and harder, and so that pushes people into other movements inside the market, other asset classes. One being real estate. I already showed you real estate. One would be the cost of rent. I haven't showed you that. I'll show you tomorrow, but the cost of rent has increased too. Another would be the amount of cars being bought. The price would have gone up in that. The real medium price for cars is now about $30,000. It was about $25,000 a little bit ago. So it's gone up in there. So rent's up, housing's up, vehicle is up. So we should be seeing maybe a price in a commodity increase as well. So let's go see if we can find up a price of commodity here. Let's look at corn. Well, since 2012, corn has kind of come down in price. That means that it's been cheaper to produce corn and more corn is out there, but your rate of return is a lot lower there. So look at that. That's interesting. We're seeing our commodities starting to depreciate as well. That's a pretty crowded trade right now. Now, mind you, corn is one that will change. You get a good flood, you get a good fire, you get a good hurricane, you're going to see the price in corn shift very dramatically. So you can see the commodity come really down here. Interesting. So now your commodities are kind of bringing in a life of its own. Now let's go look at oil. So, going to look at light sweet crude here. Light sweet crude is what a lot of refiners use to make your gasoline, your heating oil, your jet fuel. You can use hard sour crude, but it takes a little bit more a different refinery process. A lot of refiners like this light sweet crude. So, when you're looking at petroleum-based products, they use light sweet crude as well. So, let's go look at a 3-year. Let's go look at a 10-year. Daily chart in oil. So look at this movement. So nice movement into 2002, 2012, 2013. Now oil did have a little bit of a change when it came to, well, there was a lot of speculation in it, and there was a big glut in it because a lot of people were investing in it. And then right around 2014 we get a big movement down, and it's kind of staying down here. So oil's kind of depreciated too. It's interesting to see commodities actually come down as well when the velocity of money is starting to slow as well. Now, it is a little bit of an outlier. There was a lot of refineries going on here. There was the big boom into fracking. There was a big boom into shale. going into oil, and then we just produce too much of it, and once you produce too much of it, now the supply and demand is very short here, and then oil came back down to its fair price in which it's currently being used right now. So take that into account. So you can't really invest in oil anymore. That boom is gone. You can, but it's a pretty crowded trade. You can't really invest in real estate because you saw that it's up 18% where it was from the highs in 2007. You really can't invest in cars because the cars where it is. The U.S. consumer is currently not receiving a raise to actually equate to this cost of living increase, and so let's go look here. So what happens here? Well, you start pushing people into alternative investments. You push people into maybe companies that haven't quite IPO'd yet, looking at Uber, who's over $60 billion in valuation, even though all you are is an app on a phone with a GPS that allows people to pick up in rideshare. Interesting, look at that. A lot of the valuations in that IPO, if Uber does ever IPO, they're already gone. They're already tapped before it even IPOs. A lot of the valuation of price discovery is gone from Uber if it ever IPOs, because there's so many investors already crowded into that trade. A lot of stocks that are kind of new on the scene or getting ready to IPO, a lot of the price discovery valuations are already out because so many funds are ravenous for yield that they're buying stocks that aren't quite hit the market yet, and they're going to lower liquidity assets. And so let's bring up the one liquidity asset that I wanted to show you right now. You're going to find it very interesting. So velocity of money in stock. Look at this movement down from 2006 to current. So we're going to bring this over here so you can see it right here. And let's go look at the price of Bitcoin from 2006. Well, this is all from currently to now. It really didn't come out until like 2008. Now it's really spiked up. Look at this. Velocity of money, velocity of Bitcoin. Look at the huge Bitcoin. You're pushing people in alternative assets, and they are ravenous for it. Just absolutely will do anything for that yield. Funds are closing down to get into Bitcoin because they can't make a yield anymore in the market. If you listen to Stanley Druckenmiller, sorry, he has some good
globally 1 in 10 people.
Good reasoning what's happening in this market. He says asset class are in a bubble. Pick your bubble. We're in it. Bitcoin in a bubble. Cars in a bubble. Bonds in a bubble. Housing in a bubble. Credit card loans in a bubble. Now, some say, well, if you can see yourself in a bubble, you're not really bubble, and that's debated economically. But I'm here to tell you that just look at the data. I couldn't find the cost of chips, but we already looked at the price of corn. We looked at the price of corn, and it has come down significantly in the last couple of years. Why is my dollar bag of chips now $2 at the store? If inflation wasn't there, and the price of corn has gone down, or sorry, corn chips, why are my corn chips so expensive? The price of corn has come down. It's come down significantly. I've showed you the chart. But why is it more expensive at the store? The velocity of money is stagnating. And so we have all these charts and we have all this data. It proves that we are seeing a stagnation in the economy, and we're kind of seeing a topping out. And so you're pushing and pushing and pushing, and kind of like when you have a water balloon. You squeeze it, well, it doesn't quite pop. It kind of forms to your hand, and it finds a way out in the cracks into a little bit of the area here, and it doesn't quite pop yet until you put too much pressure on it. But it starts to give away at some spots, and then it pops. And we're seeing that giveaway spots are into alternative investing. So it's interesting to see this data. I do think the market is a little bit over hot here. And so where do you go from here? You can't buy the market because yields are so low, and the money you're receiving is not quite equating to where you can buy more. And so what's the alternative? Well, you short an underlying fundamental of that stock or of volatility. So you short volatility to kind of get that return, because everyone's short volatility right now. Volatility goes up, immediately slams right back down because a lot of people are in that short volatility trade. A lot of funds have come out and said that's the only way we can make a yield or get these returns. We can't really get these 30, 40, 5%, 10% returns anymore. But by the way, if a fund ever gets more than a 5% in 1 year return, you need to seriously look at their books. And now we have volatility that's been depressed. 2017 is going to go out as the lowest volatility with the most daily closes in the VIX in history. In history. There has never been this many lows put in the VIX ever than it has this year. Housing has never been higher than it was this year. Wages are going up, but the wages are not meeting the demand for housing. Cars are going up in price, but the wages aren't there. Food is going up, but the wages aren't there. Every side of the economy is getting squeezed. It's getting juiced for as much as it can be, and there's just not really the rate to return those yields anymore. What happens when your consumer no longer has enough money to consume? They cut back. But how can they cut back on something that they need? You don't have to buy potato chips at the store, but you do have to eat some fruits and vegetables, or you do have to eat some form of protein, and that's up in price. But it's up in price, but the farmer who's producing it is not getting that return. The farmer is not seeing an increase in his yield on crop. A lot of farmers are moving to crops that actually yield a return, and it becomes very, very difficult on the environment, and you can't do those forever. And to move over, say, to like almonds in California, it takes a couple years for you to establish those almonds, and there's not really the water for it, but that's what farmers go to get the money. Apples are not worth as much as they are at the store, and if they are, they're very cut, and you're getting maybe even fractions of cents to produce apples that cost you maybe 5 to 10 cents to produce after you factor in all the water, fertilizer, seeds, because remember, a lot of seeds now are patented, and to grow crops from certain seeds, you have to pay certain producers to use those seeds, and those crops yield sterile fruit that you can't use the seeds to regrow the plant, and so next year you're buying new seeds, new fertilizer, and you're kind of scorching the earth doing that. So the farmer's not seeing the increase in his yield. So again, it's really interesting to see where this market is heading. So are asset classes up? Yes. Is the market up? Yes. Is yield up? No. Yield is shrinking rapidly. Looking at the weekly chart on the S&P 500, it's still pretty overbought. Though, those are long-term fundamental problems. The market hasn't traded on fundamentals in a long time here. The market's just trading on buy the dip, buy the dip, buy the dip, buy the dip. What's the tax news coming out here? What's the tax news coming out on corporations? Are the corporations going to use this money to potentially make more jobs, or are they going to issue more bonds to buy back more shares? When yield is low, banks can't lend out that money. They might not make a return on it. If that person defaults, there's no real money to kind of recoup from that asset that's currently way overinflated. And so once yield increases, or interest rates increase on bonds, or interest rate increases on the medium yield, the 15-year, 20-year, 30-year loans, well, banks now have money to free up. So next year, depending on what happens with yield, we might see the first time ever that the amount of money in the market actually increases, so the value of the dollar dilutes. Yields are going to be higher, but there's no yield to kind of get. So you're going to see the velocity of money try to increase, and it's going to fail because there's just no really startup to kind of produce it. Now some might say, well, we might do an infrastructure spending bill. Well, what's interesting about infrastructure is I have a friend that runs a scrapyard. A couple years ago, I think about 2 years ago, the price for 1 ton of scrap iron was $25. It was nothing. All of a sudden this year, it's now $100 to $150. It's gone up ravenously. So it's interesting to see what's happening here in the market. So just take that into account. Now let's jump over the market really quick. Sorry about soapboxing a little bit, but I thought it was interesting to look at asset classes. I mean, look at Bitcoin. You squeeze that balloon, you squeeze that water balloon in your hand, and it pushes people to alternative investing. And I don't know about you, but something that jumps from $900 to $1,900 in less than a year, it jumped from $1,200 to $1,900 in less than a week. That tells you how unhealthy this market is when you start seeing ravenous people that should not be trading moving into assets they don't quite understand, like Bitcoin. The yield is ravenous right now, and it's getting worse and worse and worse. So keep that in mind. Now, the economy is kindly picking up. I do agree with Janet Yellen there. Unemployment is at 4.1%, though they do exclude people that are not looking for jobs anymore, or just people that are retiring. They do exclude them from their metric here. But wage growth isn't really there. Assets are overinflated. And so I do think we do have a real problem that's kind of being skirted over. Now, I don't think Bitcoin is going to be the answer. I do think blockchain is definitely going to help make efficient a little bit of the inefficiencies in banking right now. But is it a game changer? Banking, yes. Buying products, no. Pretty much the ability to buy something for the retail investor is not really going to change any more than it has. Now, there might be a little bit more efficiencies in it. You will no longer see maybe a transaction fee. But when you're buying something for $1,000, paying $3 for a transaction fee is not a big deal. When you're buying something for $100, a $3 transaction fee is a 3% increase. So that's a little bit of a deal. So just take that with a grain of salt. So let's go look at the general indexes real quick, and then we'll look at my trading, and then we'll wrap up for the day. Sorry I went a little bit over time, but I think it's important that we look at overinflated asset prices and really shine the light that we are looking at a little bit of a problem that's not being talked about that much. Now, looking at the S&P 500, we did have a down day today, which is interesting to see after Janet Yellen talks. It's not typically a down day after that. Usually we see it come up a little bit, and that's because she gave a dovish tone. People are expecting her to be a little bit hawkish, so keep that in mind. Usually the market's going to be holding sideways going in towards the end of the year, and it looks like it's definitely holding this range right now. Now, if we do dip down, the range to look at is going to be between 266 and 262 in the S&P 500. Next up is the QQQs. With the tax bill coming, it might not be as good as people expected for the big mega cap companies, and so we are seeing a little bit of uncertainty in the Qs here. But again, remember, it is a holiday season, so we should be seeing volume kind of lightening up here, and a kind of a trend a little bit smoothing out here for the Qs. Next up, the IWM. The IWM has had a nice reversal here from this big down movement it had prior in the week, and it is kind of just sideways trading here. Now, why is that? The tax deal. So keep that in mind. Now, let's go look at our commodities next. Let's go look at the dollar, the DXY. Now, the dollar had a pretty ugly day today. Look at that downward movement. That's because of Janet Yellen's dovish stance here. Now, what does that mean? That means that we should see gold in GDX move up here. So let's go look at gold. And you can see a nice build up into gold here. It tested a very important area of support, sustained it, and bounced up. So gold is pretty oversold. And so we could be seeing it bounce up into the gap to this 119, seeing a little bit of retracement, and then come back down. Now, if we do pierce above this 119 or 120, gold could move back up into the 121, though I do think it's going to be pretty problematic unless we see weakness in the dollar going into next year. Next up, GDX. GDX, again, was another oversold sector, and you look at that big movement today. Now, we did say oversold in RSI, pretty bearish, oversold in the MACD, and oversold in stochastic. So seeing a retracement like this is not too out of the norm. Weakness in the dollar is good for GDX as long as the price of gold goes up as well, and we can see that did happen today. Though I do think this is a little bit of an oversold rally, and so if you're going to play it, you can play it tomorrow, maybe the next day, and then probably get out of it. Unless you want to re-up into your shorts, and then that would probably be okay to play it that way as well for GDX. Now, we did have EIA petroleum status come out today. I have a lot of economic stuff here, sorry. Now remember, I am a fundamental trader, and I do like to look at the fundamentals of the market. Fundamentals really have not mattered that much, though they will one day come to light again. And when you look at the fundamentals of a product, it kind of helps you understand a little bit more. We're looking at a lot of technicals right now, but remember, the fundamentals are pretty important as well. The fundamentals are what's its cost to the debt ratio and stuff like that. So keep that in mind. I do love the fundamental of trading, but a lot of the market is not. It's just blindly buying yield. It's just blindly buying yield. A lot of podcasts I follow, Trading Justice, The Disciplined Investor, Frank Kurzweil, they're all talking about this. They're all very smart people, and they're all talking about the hunt for yield is ravenous, but it's getting very worrisome in it. To quote Warren Buffett, be fearful when others are greedy, and be greedy when others are fearful. Well, right now I'm fearful because a lot of people are being greedy. So, being really, really fearful right now, and that puts me a lot of risk off. Now, EIA to come out with a nice drawdown in oil for the second week, but gasoline built up again. So that is going to be problematic for our USO. As you can see here, gasoline building up is the main thing to focus on when it comes to oil. So keep that in mind. It does look like we are still staying within this range, and I do think it is fundamentally overextended here, and so oil is still a hands-off. Next up, look at TLT, and then we will look at my trades and wrap up for today. Now, Janet Yellen did say she is going to increase bonds, and we can see that a lot of buyers came into the market. It's a gap up, which is really weird because when yield moves up in bonds, it means the price should go down, but we saw it go up. So, pretty interesting to see what's going on here. Now, it is getting to the point where I think it's a little bit fully priced here around this level. And so, am I going to be playing TLT? No, I'm going to wait for it to kind of show an area of weakness, and then I'll maybe look to put a long put on it as it moves back down going into 2018. Last up, let's look at my trading. My Apple naked put is finally coming down to a place to where I could close it for 0.04. Most likely I'm going to have to close it for a nickel. I want to close it for 3 cents, so I'll leave it on for a couple more days here. Though if it starts to turn, I'll just close it and take my profit on Apple. Same trending forward. Microsoft has come up again, but I do have a covered call, so it looks like it's going to get called away. And I'm okay with that. The SFIX, I put on a new 100 shares of it at 122. It did come back down a little bit today. If we go look at the 2-minute chart on the SFIX, it was really concerning that it came down after Janet Yellen spoke. Not only did it come down, but it broke the daily range. This was the daily range inside of it, and it came down in the after hours. It kind of recovered, but not much. Not normal for after Janet Yellen speaks. This is not a normal trend. Usually it moves up. Same with the VIX. After Janet Yellen spoke, we saw the VIX kind of start moving up. This is not typical movement for the VIX after Janet Yellen speaks. Seeing it sustained at 10. So it is something to keep an eye on. The VIX doesn't typically roll up after the Yellen speaks. And so if it washes out tomorrow, that will be okay. That is the normal trend here. But as it moved back above 10, that's something to keep a close eye on for the VIX. Now, I did open a 122 long 100 shares on the SFIX. And I also sold a 124 9-day out or 9-day till expiration call. And I used some of the premium to buy a long put, a 118 long put. So I did buy at 122, it sold at 124. So if it gets to 124, that's good. I did take a lot of the premium to buy a put just for protection, just because it was acting a little bit wonky. And I do think it's a little bit overextended, though I am losing my 200 shares to my covered calls this week here. And so I am just adding to my position here. I'm just going to cash flow it again. Now, I'm only going to add 200 shares once it's above 120 here. And I'm probably going to be moving into calls, but calls are pretty wonky to put on the SVIX here, so it's kind of hard to kind of price them. So I'll let you know when I actually put those calls on. UVXY, my trade is pretty much the theta decaying as much as I'm going to get it. I want to get it down to 10 cents here, and it's going to take a couple days for the UVXY to get there. There has been no news from ProShares as of right now that they're going to split the UVXY again, but it desperately needs it. Once it collapses below 20, it's pretty much a broke index. It needs a lot of the dead shares are drying down on the equation that makes the UVXY. So expect a announcement probably towards the end of this month of when they're going to split it for the UVXY. For the VIX, I do have my long 114 calls that I put on from another trade that I closed, my short trade, and I'm just going to leave them on to hedge my SVIX position. So those are my trades for right now. If you have any questions, comments, concerns, I will be in the chat room until the video is uploaded. The kids are at a Christmas concert tonight, so I have the luxury. And they're not their Christmas concert, otherwise I'd go there. They're at their cousin's Christmas concert. I would be at my own kids' Christmas concert. They're at their cousin's. So until then, I will be in the chat room. If you have any more questions, feel free to pick my brain or use the wealth of knowledge that's on this site to do your own fact finding. So until then, this has been your market recap. I'm Jake Pelly from Wall Street IO. I'll see everyone tomorrow.